Hi everyone, my name is Yogesh. Welcome to another episode of Appreciates podcast, Dalal Street to Wall Street. I have with us a very special guest today, Mr. Arindam Mandal. Mr. Arindam is the head of Global Equities at Marcellus. Hi Arindam, how are you?
Hi, Yogesh. I'm doing good. Thank you. Thank you for inviting me. Glad to talk here.
Likewise. Fantastic. So Arindam, if I allow myself to go down the memory lane, right? So the first time I had visited the US was almost exactly 10 years ago. That was June of 2015. And at that time, one US dollar was roughly 63, 64 rupees, right? Versus fast forward these 10 years. And now, as we all know, it's around 85, 86 rupees, right? So this automatically is about a 33% hidden benefit that an Indian investor would get if they were investing in the US markets, right? And I know you've been advocating a lot over the past years for diversified and US based investing for Indians. And in fact, you've gone a step further, right? Because you had a very illustrious career in the US where you were helping investors invest both in US as well as in India. And then you made the move a few years ago to India to help Indians invest in the US as well as in India. So, very curious to hear from you based on all of your experience. What are the bigger things, or what is the bigger picture that you are seeing most investors in India are missing right now?
You're right. Absolutely right, Yogesh. So when I moved to US, it was in 2011. The first time I came to US. At that time, OP was actually 51 or 52. So from since then, 70, 71%, the rupee has depreciated. Look up. My point here has always been the currency prediction. It's very hard to do. You can always say that between 2002 to 2007, rupee actually appreciated in value. Now, if I think of it rationally, longer term, the rupee should depreciate. Depreciation should be something, the difference between the inflation rate between these two countries. And given India is a higher growth country, the inflation here is going to be around 4 to 5%, close to that. Around 2 to 3% is a reasonable expectation. Compared to that, if India sees 4 to 5% inflation, that means that there is always 2 to 3% of delta. And that should get reflected in the currency depreciation. It is not going to be every year. It can be in parts. That should be a normal, healthy way to depreciate your currency, especially if you are bullish in India or you are bullish about the export economy that you are typically preaching about India. So if you want Indian exports to do well, you want that 2 to 3% of depreciation. Nothing wrong in that. It doesn't think anything about the country. Now, going back to when I decided to move back to India, so it is actually quite interesting. In fact, just 5, 6 years back, I was preaching people that your India allocation is actually quite low. If you think about any global portfolio, the India allocation was barely 1.5 to 2%. Even if you look at the MSCI ACWI, the index that represent the broader market, India's weight is like that, and 1.5 to 2%, somewhere between that. And still, I think it's around 2%. Now, our point was that do not put India is like any other emerging market. The growth opportunity in India is actually second to none when you compare other emerging countries. So the allocation should be much higher, not that 2%, which no one actually cares about. Right. So as we started doing more and more work on India from 2017, 18, 19, I used to interact with a lot of people to get data around what how the Indians invest. So one thing was become very clear that as the global allocators tend to ignore India, similarly, if you look at the local Indians, even the affluent Indians, they tend to ignore the compounding opportunities overseas. And it is nothing really nothing to do about, you're biased about India or you're biased about US. It is a natural regular asset allocation. As you grow, as you become bigger, as you become more wealthy, it is natural for you to diversify. For example, you look at any US allocator, the typical 80% in US equity, 20% in international equity, even though there are legit reasons that why US is going to be probably compound better in longer term. That the diversification is something that is, we call it freelance, we talk about the later, but that was something that we feel that it is missing. Now, if I just put some numbers over here, or just think about it. Last year, 2 crores, close to 2 crore people actually earn more than 1 crore. Okay, 2 crore Indians will file income tax more than, not 2 crore, sorry, 2 lakh. If you look at 1 million people, the average annual income is around more than 2 crore rupees. So $250,000 in dollar terms. So if you just think about that opportunity set, we are just talking about 10 lakhs of people or 1 million people. If you start to diversify in global equities, why that not at practically anything. You just go there and ask, talk to anyone, it's just relax. Either it is through their employee stock options, if they are working in these US MNCs, or they have taken position in some just being no well-known names, just playing around, keeping the toe. So the opportunity set seem huge, and what is not the opportunity, but at the same time, if you're an investor, you should take benefit of what is going across the world, right? So you do not get certain types of companies that you typically get investing elsewhere, right? Again, your story is very much tied to economic growth, whereas the story in the rest of the world are tied to different other things. That is what we wanted to build to people. At the same time, you have to remember one thing. In longer term, if you look at 10, 20, 30 years, these two markets tend to do pretty well. Right? So you're not giving up on returns. It is just that you are trying to diversify to mitigate your risk. If you look at the number of students that are going out of India, I think last year the number was around 900,000. So around so close to a million. And said 10 years back, it was around 350,000. So that number is going at around 8-10% CAGR. And if you think about the expenses, and you and I both went to these schools abroad, if you think about the kind of the tuition fee that the rate is going up, if you want to hedge that expense in future, that is your dollar liability from India standpoint. So for that, you need to separate out some corpus to make sure that when your kids go out, you're not scrambling to send money. You might have money that are having workers, etc. Not scramble through that. So those are the 3 points. Like you get access to some of the best companies in the world, which is very different from the economic growth story in India. Number two, you are becoming much more worldly, so you have to be a little bit smarter in terms of managing your money. Number three, well, for your liabilities in future, you might not be in the local currency. And top of that, what you exactly saying? If there is a currency movement in your favor, there's no topping on the cake.
So that's fascinating, Arindam. You touched upon several very important aspects, I think, right? So you talked about how diversification is perhaps the only free lunch. You talked about secular macroeconomic trends. For example, more and more Indians are earning substantial amounts of money. Indians are becoming more globally mobile, more globally ambitious. You also talked about that there is an inherent economic delta, which will continue to drive 2 to 3% INR depreciation versus US dollars, and which basically means a hidden return that a US dollar investor will get over time. So those are, all very interesting points. I would love to deep dive into several of those. The first one I do want to get a further take on is that you mentioned diversification and geographical diversification is perhaps the only free lunch in investing. So, and I was in fact reading one of your research articles, and how you mentioned that the market correlation between India and US is just 0.4, 0.5 versus Europe is a lot more, 0.8, right? So our 80% correlation between US and Europe markets versus only 40-50% correlation between Indian and US markets. So now look, all of us have always heard don't put all your eggs in one basket and things like that, right? We have said academically what is the benefit of diversification. But if we leave the academics on a side, given the fact that you spent several years on Wall Street, what convinced you that there was a real alpha in global diversification, or a real return opportunity in global diversification beyond just academic theory? Would love to hear your perspective on that.
Yogesh, and you raised a very valid point. As I said, when I used to pitch India, India used to be put in that basket of countries, emerging market countries. So never really looked into the correlation, etc. Just pertaining to India. So in 2018-19, when I was pitching others, my investment committee to increase the allocation towards India, etc. That point of time, we ran some numbers. That is exactly that you're referring to. Now, typically, if you think about when you talk about diversification, stocks versus bonds, 60% stock, 40% bond, that's a age-old thing that people have followed. They're not actually compromising on the returns. The bonds are not supposed to deliver returns. It is just that it will be supportive when there is a market drawdown. So your portfolio is a little bit more secluded from the broader equity market downturn, but you're giving up returns on that. Here, the unique thing is you're not giving up on your return. You take 10, 20, 30 years, both these countries have delivered a reasonable double-digit dollar return. You take the largest, the most important index in India, which is Nifty 50. The equivalent there in the US is S&P 500. Do a very, very simple exercise. Just take any 20, 30, 10, 20, 30 year block. You'll get the returns which are very similar, 1-2% here and there. Now you do a very simple thing. Take a 50-50 portfolio. Suppose you started investing 30 years back with 100 rupees or $100. You put 50 in Indian market, 50 in US market. You rebalance the portfolio like a mechanical robot. Uh, at the end of every year, you make sure that the portfolio, either you put new money to make sure that the portfolio is balanced at 50-50 is there. If you continue to do that, what you'll see is overall return is actually slightly higher than both the markets. That is number one. Number two, if you're an Indian investor, Indian investor, the risk, the volatility, that get reduced by around 30-40%. Right? So that is a big thing. That is a big thing. Now remember, one thing is very important. That is exactly Harry Markovich spoke about that, that is the only free lunch available. And it was actually surprising that the two biggest free democracies in the world, they actually offer you that. And given India is such tiny part of the global market, we never really observe. But that is the fact. Now, if you just think about it, your allocation to a certain asset class can go up significantly if you know that asset class is less volatile. You getting my point? If you know the void there can be a drawdown of 40-50%, you'll probably put less money into that asset class vis-a-vis if you know that the drawdown is going to be 15-20%. Right? So it gives you two necessary impetus here, right? You can make a slightly more money and you can put more money for the compounding, right? So that is where it becomes much more powerful in our view. And if you look at even the events that happened across these countries, the specific country events, like for example, in India, we had ILFS crisis, we had the demonetization in 2016. Similarly, vice versa, if you think about the interest rate hike that went in 2022 or the dot-com bust that happened in 2001, that a very different impact on India vis-a-vis the US. So you get benefited from both of these, just mixing these assets. If you can do it in a smarter way, that is even better. But even a very easy construct that I'm telling you, that can also add powerful value.
That's amazing. That makes a lot of sense. Let me ask you an insider question now. So, of course, Global Compounders portfolio has delivered, market beating returns. So, the numbers I was reading is since inception, it has given over 24% versus the S&P 500's, 17-ish%. Even this year, when the volatility has been very high and there have been significant drawdowns, like S&P fell 4.3% versus your portfolio only said, 0.08%, right? So the insider question I want to ask you is, do you attribute the success of your portfolio to this exact diversification benefit that we've been discussing, or are there other aspects of it as well that you would, share with our viewers?
All right. Uh, no, this is a great question actually. So in terms of diversification, remember one thing, Yogesh, that this is a global portfolio. So you do not have any Indian mix there. It's a pure global stock. In terms of why we held up better than the rest of the market, I would say that it is definitely diversification, but at the same point, when we build the portfolio, we had something in mind that we do not want to be in the most crowded part of the market. Okay, so that definitely helps. We are typically looking for your boring businesses. That is the crux of it. We're looking for boring businesses, and despite to acknowledge all the excitement that is there in the AI or different other newer technologies coming in, we're typically looking for companies that has been there from multiple business cycles. So you have been there, this business have been there in survived through multiple business cycles. They have seen the ups and downs. At the same time, they are not in the most crowded part of the market. So that is a natural hedge when some of this hype narrative is driving the market and that goes away. You have a natural hedge, and to some extent that played out during the downturn. To be very honest, at the same time, we think the construct of the portfolio is in such a way that in the bear market, it should tend to do well, because we are not really focusing on the top 10-15 names that everyone talks about. We're trying to figure out ideas which are bottom up. We're trying to focus on ideas which are dominating in the niche areas where the volatility around earnings are actually quite low. So if you look at the companies that we have invested into, in any prior downturn, their earnings have been much more resilient uh, compared to the index. So again, it has its pluses and minuses. You might have a year like 2024 where certain few stocks delivered most of the returns. We lagged by I think a couple of points that time. But broadly over time, it generally adds value. As I said, the volatility is much lower, so you can you can stay much more peaceful.
Got it. That makes a lot of sense. So, if I piece the two things together, right? Let's take a step back. Let's think about and let's discuss what does this mean for a regular Indian investor, right? So the 2 points we have discussed that I want to call out as a summary is one is diversification is good, right? Because Indian markets and US markets behave differently. Their correlation is low. There are different benefits. There are some very fast growing and cutting edge companies in the US. Indian economy as a whole is growing. So there are benefits of, dramatic benefits of diversification. So an Indian investor should diversify globally. So that's first part we have discussed. The other part, which is very interesting that you just mentioned, is also it's not just geographic diversification, but it's important to pick the right assets, the right stocks. For example, in a volatile condition or market scenario such as this year, picking more resilient, investing in more resilient assets and more resilient stocks is beneficial and good for the portfolio. Now,
Right.
I tell you one thing that I would love to hear take on, right? I think we, are aligned in this philosophy, but when I see most Indian investors, right? So I'll tell you the conundrum I always see, which is as per the liberalized remittance scheme, LRS by the Reserve Bank of India, every Indian can send up to 260,000 US dollars every year outside to invest, to spend for education, etc., right? Now, even though there are, so many Indians over, you mentioned over a million Indians that made over 2 crores in income last year. But when we look at most Indians, they barely invest $10,000 to $20,000 outside, right? On the indirect equities. On the other hand, we see mutual fund industry has, every time it hits a $7 billion global exposure overseas investment cap, right? If we take these facts together, right, which is it is better to be diversified, but in assets which are resilient, which you need to be selective about. But when you take this conundrum, which is most Indians actually don't end up investing in, selective or resilient or a research-driven way, they just end up investing in a mutual fund, which, can't even take money because they hit their, overseas investment cap. So can you maybe, break down the various practical advantages that our listeners should be aware of why is it that they should look to invest themselves, benefiting from this LRS limit and not be constrained by the 7 billion cap because of which they can't invest through mutual funds?
Absolutely, Yogesh. You're right. The 7 billion cap, whenever there's a bit of opening, that gets filled up very quickly. So it shows that people are willing to take it out. But probably the LRS is something that many people are not that aware of. Or even if they know about it, there are certain challenges around something that is called TCS, tax collected at source. So, for example, if you are transferring, say, $100,000, you have to make sure that your account is $120,000. The 20,000 would be taken from your account as an advance tax. So that is definitely a kind of roadblock in people's mind that whether I'll get back the money, etc. Not. Now the reassuring fact is that there has been certain changes in regulation in last year, where you can always adjust the advance tax against. If you're a businessman, you are anyway filing your advance tax probably every quarter, so you can offset that. That's for sure. And even if you're an employee, if you're a salaried employee, you can just take that TCS certificate. You will get it mentioned in your 26 AS. You can take that to your HR and say that, you know what, I've already paid this tax. Can you adjust my salary from this with this deduction that has already happened to me? So that is actually pretty good. So we are seeing these things changing now. One thing I'd like to mention is that even though the leverage, the LRS is a very good way to, it is to take out money. There is a classic difference between the fund of funds, so the feeder funds that the Indian mutual fund houses typically run. There's a massive cost arbitrage that people should know about. I invested in one of them for a long back, and if you calculate all the costs that are included in what you end up paying to them, even though expense ratio will say somewhere around 1% or so, but the total cost that you end up paying, because there are multiple layers of fees that are involved there, it goes up to around 2% or more. Okay. But suppose you want to take it, you convert the money in dollars, and then from there you can actually buy a NASDAQ ETF, things like that, and you can you can definitely invest that. That will come probably somewhere between 0.2 to 0.4%. So that's a big delta, 1.6% delta. And if you know, that is a quite a bit of alpha. Like if you're an active manager, wanted to, that is huge alpha. Right? That is one thing. Number two, the thing that you should be mindful, and that is where I think the active management part might add some value over time, is the fact that typically what I've seen is that people chase return. So when a market is doing really well, people try to go and swap that market, and that is when actually you should not do it. So that is where if you have an active manager doing it, who is managing the volatility really well, that might be adding some value that you don't got into the last leg of a rally. So you always leave with a bitter taste. You don't want that. This is a good market to be. Just be more rational. So in that case, you are not susceptible to when some mutual fund or RBI is opening their cap. You can take a decision on your own, like when I want to behave, take my decision more rationally. That is why I think the error scheme is actually pretty good. And if you look at it, I mean, $250,000 per pan, that is the limit. I don't think, of course, there are super rich who consume that every year, but broadly, you will not find people using more than 20, $30,000 or more than that. So the remaining amount, I think, is good pocket, good part of their money that can be invested in global equities in any shape or form.
Absolutely. Yeah, those are excellent points. And I think 2%. So I'll get you up at Appreciate. We only charge 0.05% to customers versus 0.05% versus 2% that with all the hidden fees that you're mentioning through most funds that customers end up paying. That's a huge delta, right? Over 10, 20, 30 years, that can sum up to crores of rupees of of missed returns that an investor might have. Wow. Okay. So I think that's a very powerful message to our listeners to explore not just the mutual fund route versus also the direct route. Arindam, I do want to get your take on one more thing, which is I read the news every day. There is every day a new U-turn that the new administration in the US takes. Some people, some journalists even call it the taco trade, which is Trump always chickens out. And there is a lot of chaos around tariffs and then U-turn and then deals with different countries. So a lot of our listeners would be concerned about this volatility. What would you say to them?
You're absolutely right. Since the last 6, 7 months, it has been, there's a lot of narratives. But I would say one thing here, do not try to time the market. The one thing that you should be really concerned about the valuation of the market. Broadly, our recommendation or my recommendation is that you should always stagger up your investment. So you just think about what is the final goal. And for that, how much money I really want to put in that corpus and distribute it over time. If there is a correction, take advantage of that and you well along with it. So it is not a short-term timing thing. Unless you dip your toe into it, you will be most of the time you will be in that cohort that always thinks that the market will correct more, and you probably miss out the bottom, and you think that the market has already recovered. Then what do I do? I wait for the next leg down. It is very hard to do. The staggered way of investing is the right thing to do. So narratives will be built. What we can do is that to identify good companies, pay reasonable valuations, stay invested, identify the companies that have survived this kind of challenges over time, and over time you will see that your money is getting compounded. If you want to get it to more complication, the fact is that nobody knows. The fact is that nobody knows. The only thing that you know is just be the old saying: be fearful when everyone is greedy, and be greedy when everyone is fearful. But to your point, if I look at the market now, we do feel the market is a bit overrated, especially in certain sectors. But that is where terms of being more judicious in what assets you are picking up is actually more important. So we are following very barbell kind of approach. We are looking for companies where we are certain about they'll be able to deliver earnings even though they're a little bit highly priced in terms of valuation. On the other side, we are trying to find good assets which we think has been kind of beaten down too much. And if I go back to the history, these guys have compounded at close to mid-teens or low teens, but they've been pounded because of certain challenges. So again, we are trying to take a barbell kind of approach, acknowledging the fact that the market can keep rewarding the ones that are delivering earnings, and while beating down the others. That dichotomy can exist for a long period of time, so you don't have to get caught off guard. But I can assure you one thing: there is a large part of the market which hasn't done practically anything in the last 4 years, and you do see quite a few good assets that are available at a reasonable price. So as long as you can do that, I think the volatility, etc., is part of the game. It is just the narrative will change take different shape at different point of time in the cycle. But finding right companies that sit around it. I mean, if you're in equity investment, you're supposed to see a 20-30% drawdown in any given year. It is quite possible. So you don't be the taco thing here. Don't chicken out. Rather than you just focus on what you know more, know best. That's what we're trying to do.
Got it. So, how did you, I was looking at your portfolio, and one of the very interesting CEO or very interesting thing I saw was your portfolio is about, 36% in industrials. So that's companies like, Halco, etc. That felt to me quite a contrarian trade. Can you talk a bit more about what was the rationale for that? Not particularly that company, but in general, the industrial sector, right? Because is your thesis that there is going to be an American industrial renaissance, or is this more about these companies being available at the right price?
Absolutely. One of the thing, of course, your last 2 points are actually correct. I think there's a bit of it, definitely that's playing a role there. But one thing I'll mention is that I started my career as an industrial analyst, US industrial analyst. So that is definitely playing a part into it because I have covered that industry for a long, long time. And as I said, I was in Midwest, as you know, there's an industrial belt. So you tend to know many of these companies very well. So what you've tried to do, Yogesh, is that we are looking for fancy compounders, to be very honest. One great thing about industrials is that the durability of these businesses are actually humongous. It is not as disruptive as tech, right? You'll not find too many tech companies surviving more than 100 years. You'll find companies that exist in our portfolio, like for example, you own a company called Parker Hannifin, an industrial tech company, okay, close to 100 years, or probably more than that now, right? So you find these kind of opportunities that people tend to miss out. And to be very fair, I mean, it is not that you are giving up on returns. So in any 10-15 year time frame, just do a rolling CAGR. Parker Hannifin gives you a total return of around 13 to 15%, and they have been doing it for last 100 years. A time frame between say 2011, 12 to 2017, 18, when practically there was an industrial recession, freight recession in the US. So nothing happened in industrial actually. And during that time frame, if I look at the entire 2010s, Parker Hannifin still beat S&P very handily. So these are great capital allocators. These are great capital allocators, and they are taking benefit of a fragmented market. They are taking benefit of the companies which are not running that well. They try to bring them together and put it in their operating system. People who I'm not sure they know about operating system. This kind of a lean Six Sigma kind of approach that many of the industrial companies take. And you find that these companies are compounding at a 13-15% CAGR over a long period of time. And you get them at a very cheap valuation, right? And as I said, our goal at the onset was very simple. We are not going for moonshots. We are going for very predictable businesses through cycle. You will find one thing very interesting is that the crowding in the companies which are growing at 20-25% is much, much higher than companies that are growing at 13-15%. That is probably the neglected area. When you go into that crowding market, it becomes very hard, right? Number two, we are not looking for companies which are operating at a very high TAM, total addressable market, or which are growing their top line at 15-20%. We don't want to go there because a lot of capital keep on chasing those markets. There is no dearth of capital in the world. Just remember that, right? So if you avoid them, then industrial comes out to a very nice bucket. You have chosen your niche. Within that, you have a market which is fragmented. You can consolidate that. If you cannot do that, just return everything back to the shareholders. So that is why you do see a lot of allocation with industrial. Many of them are actually serial acquirers. Acquisition plays a large part of the story. And if the point that if there is an industrial in ERISA, then definitely these guys are going to benefit. So both from cyclical perspective, both from capital allocation perspective, we are quite confident and comfortable owning these companies, especially when I'm not paying too much for them.
That's very interesting, which is it is better to find assets that are not being chased by everyone, but that have longevity and have shown great returns over a very long period of time, because you can be, reasonably confident that they will continue to give those returns if they've given those returns for 100 years, versus some of the other companies might be flash in the pan and might give very high returns 1 year, but then, might not survive 20 years. So that's a very interesting take on that. Okay, so Arindam, let's bring it all together, right? Let's Let's take three types of customers. A customer that wants to invest 1 lakh rupee a month, right? Second investor that has not diversified portfolio of, let's say, 50 lakh rupee quantum. And a third investor, which is an HNI investor that wants to invest 1 crore a year. For these three types of investors, what would your recommendation be to build the best outcomes for them? But maybe we start with the first scenario in which the investor is investing between 50,000 to 1 lakh rupees.
If it is his or her investment corpus every month, then I'll say that start diverging around 5 to 10% of that through LRS scheme and build a pot, right? And invest in probably the ETFs are the best way to do it. So that is, I think, the reasonable way. We are paying less amount of money. You do not want to take the risk of going too big in a short period of time, and your active underperformance risk is also much lower. So for 1 lakh SIP, 5 to 10% allocation to global equities through LRS and ETFs.
Yes. So 50 lakh is their total quantum, but it is just in one asset there. It's not diversified. How would you approach what would be your tips for such an investor?
So for them, again, I'll say that 20% can be a good allocation in international equities, but don't do it at one go. So stagger it over, I would say, 4 to 8 quarters. And if you get reasonable drawdown, you put more. But don't put it at one go, at least at this point of time in the market. But make sure that you're doing it because it's a necessity, especially in the purview of why the Indian markets are trading. I do hear a lot of people say that India, in 2002 to 2007, India did so well, US didn't do so well. One point you miss out is the fact that yes, US multiples are back to those highs, but at that point of time in 2002, India was trading at 12 or 13 times price to earning multiple. Okay, right now India trades at around 21. So that massive 70% delta that you got at that point of time just for valuation catching up, that is not there. The need for diversification for your 50 lakh asset corpus is important. Just do it in a staggered manner.
Interesting. And then the last one is an HNI investor, let's say, who is investing a crore or nearby that amount per year. Would your recommendation remain consistent for them as well?
Is consistent. In fact, I will say that for them, it is probably more prudent to be involved with an active manager instead of doing the ETF route. I think for your option 1 and 2, to start with, ETF is a good starting point. And once they reach a certain point, you can move that money to an active management. For the HNI Pro, it is better to start with an active manager because they typically need a little bit more comfort in terms of interacting, etc. And given that the corpus is also higher. So get that comfort, you might want to go for an active manager, but the staggered way of doing it is the same in my opinion.
And then the other question that we keep hearing from our listeners and customers and investors is, do they prioritize geographies where the GDP growth is very high? Which is like, should they just look at whichever country has very high GDP growth and put their money there because the economy is growing? So very reasonable ask from our listeners. What are your thoughts on that? Should they do that?
That's a very interesting question, and we do also keep getting that. Makes sense, right? Intuitively, that's how it should be. Interestingly, that is not the case. In fact, I'm not talking about recent happenings in China, etc., where you can definitely argue that even before the downturn in China in the last 3 years, if you look back from 1994, next 25 years, China equities actually lagged that of probably Europe, definitely US, right? Despite growing their GDP at a 13-14% dollar CAGR. So despite that, China's equity market lag. Now you can definitely argue that it is not a free market, it's a bit of communism, etc. So that might have driven that. Having said that, if I look at a paper that was published in 2005 by one of the reputed, I think University of Florida professor, published a paper analyzing economic growth and stock market return over the last 25, 30, 40 years back in 2005. Right? Probably is looking at the data from 1960s. There is actually no correlation. There is actually no correlation. That is surprising thing. Definitely is a tailwind for the countries, but at the same time, there need not be a correlation, and that has been our point all through. Just to give an example, which are the companies benefited the most from, say, the growth in China? Apple, for example. Yes, Apple, right? Yes, North American companies. So 45% of Apple sales used to come from China at some point of time. Bulk of their growth came from China. So just think about it. Definitely, Apple developed a massive supply chain in different parts of China throughout the procurement process around different parts, suppliers. They generated tons of employment in China, which is good for China. Having said that, Apple with their 150,000 own employees have a market cap of around $3 trillion gone in their entire supply chain. Probably employs more than a million people. Their market cap is somewhere between 50 to 70 billion dollars. So the important thing here is to understand the value capture. Where is the value is getting captured? Value is the profit capture. The profit capture happens in the US for many of these companies, and that's what is driving the value. It is not that you are paying exorbitantly high multiples for an Apple. I mean, of course, they're high, but 25 times P, right? So if you think that, okay, this fair valuation is say 15P, just for sake of argument, and then it is a 1.5 trillion vis-a-vis a Foxconn of $70 billion, right? So the point is that as an investor, you have to understand that not necessarily the country which is seeing growth, the value would be captured by the companies that are in that country. Another example, classic example, is the luxury landscape. If you think about armies, Gucci, like or LV, massive growth from Asian diaspora and Asian countries, be it in China now in India. The value capture happens in a different place, not necessarily in India. In fact, it'll be interesting to share this thing with you. Apple will have around $10 billion of sales in India. No other consumer company other than Maruti. Maruti will have, I think, around 19 billion. But any other consumer company in India barely touch the $10 billion. So just think about it. $10 billion just from India next year. That's what Apple is projecting to get to in India. So that is the fact. So this is where the growth is being captured. And that is why we keep on saying that don't mix these two things. It's good for economy. Of course, it's good that China took out around 57, 70 crore people out of the poverty. That is great. But as an investor, if you think about it, the benefit is accruing to some of these, well-positioned companies that they tend to take benefit outside.
Wow, that was a very insightful point. Actually, that reason how I personally also think about this, right? Because intuitively, like you rightly said, it makes sense. GDP, basically companies grow. But what you're saying is, and what it has proven, it sounds like, is that investors really need to look a level deeper, which is like, what are the companies that will actually benefit from the growth of a country and invest in those countries, in those companies, instead of, because you cannot invest in a country per se. That's a very, very fascinating point. Okay, makes a lot of sense. The other question we keep getting from our listeners that are investors is about AI, right? And in particular, we hear two aspects of AI that are on people's minds. One is, how will this large growth, very fast change, rate of change of AI technology, how will that define equity investing, in the sense which companies are likely to benefit from it? What is a right bet for the next 10 years, let's say, given the large secular trend of AI? And the other aspect is, how will AI in itself change investing for everyone? Right? Will it all be driven by AI a few years from now? What are your thoughts on those two aspects about AI?
So if you think about three aspects of investing, what it used to be, one is information. Then from that information, what kind of insight that you're building, and then the final layer is behavioral aspects, right? How you're behaving with those insights that come to you. In my view, the information age is largely gone, especially in public markets. Now, insight per se, that is where we are seeing massive improvement through AI. For example, nowadays, when I am just trying this out, this notebook LMR, this tool, I use quite often. I just try to upload the recent, let's say, tech companies, what they have reported, just dump them in that and find out like what the trends going on. And the output is actually fascinatingly clear, right? I would say that the insight, a good analyst can definitely bring in more insight, but at the same time, it is not a bad start. So I think if you think about AI as your assistant, I think that is the pitch rather than them doing everything. It can be very powerful, productive way tool for at least investing. So I think the last age, the behavioral age, that is where I think it will come down to when you think about it investing, right? At some extent, that is person to person. That is very hard to kind of, code because everyone is different. There is no population model that can be defined for that. If you can bucket then that you are a growth investor, value investor, etc. But at the end of the day, it is very hard to.
So, Arindam, that makes a lot of sense. I think what my takeaway from your guidance on how to evaluate AI is that a lot of the performance benefits so far have been really the AI companies, but over the next 5 to 10 years, as AI gets implemented in various businesses, there'll be a lot of performance benefits and hence equity returns that lots and lots of other companies would also experience. Now, depending on how well the management teams performs, does come down to business fundamentals and execution. Thanks a lot. This was a very insightful conversation. Thanks a lot for taking the time and sharing with us and all the listeners these great insights and tips. I'm sure they will very much benefit from these insights in their personal investment journey.
So thank you, Yogesh, for inviting me. I think it was a good discussion. So anytime later on, happy to do it again. So yeah, no, thank you, thanks again, and all the best to your investors, and all the best to you.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.